Welcome to today's lecture. Today we are going to discuss unit number 11, which is on capital budgeting. Capital budgeting. So capital budgeting basically involves investment decisions that businesses make. Investment decision meaning that the business, they have available funds to invest in projects, in different types of projects. So before an investment is done, or before capital is injected into these projects, first of all, we need to make investment decisions. So investment decisions also referred to as capital decisions. So these are capital decisions or investment decisions that we need to make, which also means the capital budgeting. So we need to make these important decisions before we invest in any particular business. So the process is concerned with two things. One, what assets or which asset are we intending to invest in? The next question would be, how much money are we ready to spend on a capital asset or capital project? So we need to come up with a budget. We need to come up with a capital budget. So capital investment decisions shape the future of any business and its ability to manage future operations. Hence, it is important to get it right first time. So it's very important to get it right first time. These decisions are very important for every business. So what are the types of investment projects that we can embark on as a business? So these are some of the proposals, investment proposals that we can inject our capital into as a business. So we can have new projects. Then we can also have expansion in a new product line. So if you are a business, you have got product lines, you've got products that we are making or producing, we may decide to introduce new products or product lines for the business. So all those are investment projects that we can embark on as a business. Then you can also have a proposal to expansion of existing product line. So we can also expand the product line. The same products that we are producing, we can still expand those products line. Then the other last project that we can also embark on as a business is rehabilitation. So where we want to rehabilitate, for example, the infrastructure for the business, the equipment, the business, the factory for the business, so that you can have enhanced or increased productivity. So all these are what we call investment proposals. These can be investment proposals for the business. So we need to appraise these projects. So this is what we call investment appraisal. So before we embark on any project, before we inject capital into any project, we are supposed to appraise the investment. In other words, we are supposed to evaluate, we are supposed to determine whether the investment or whether the project is worthy or is profitable or is feasible. Is it worthy investing? Is it profitable? So those are the things that we are supposed to do. So that is what we call appraising a project or investment appraisal. So investment appraisal also involves calculating the cash flows and comparing with cash outflows to find out whether the project is financially viable or profitable. So as we are doing this, as we are evaluating these projects, we usually have to calculate the cash flows, cash inflows. When you calculate the cash inflows, then we need to compare that cash inflows with the cash outflows to find out whether the project is financially viable or profitable. So if we have more cash inflows compared to cash outflows, then it means the project is viable or profitable. But if you have less inflows, cash inflows compared to the cash outflows, then it means the project is a loss. It's not viable. It's a loss-making project. So only projects that yield a positive return should be undertaken so as to increase the wealth of the shareholders or investors. So when we appraise a project and we discover that it is yielding a positive return, it is profitable, it is viable, then such projects are the projects that we are supposed to undertake only. So we only undertake a project which is viable, a project which is profitable, because we know that this type of projects will be able to increase the wealth of the shareholders or the investors. It's not possible that we can embark on a project which is loss-making. So we only go for those projects that are profitable or viable. Okay, so now we can look at project evaluation. Okay. Method of appraisal. So what are the methods that we can use to evaluate a project or to appraise a project? So we have got these types of methods that you can use there. The first one is the discounting method. So we can use discounting methods to appraise or to evaluate a project. You can also use non-discounting methods. So we are going to discuss this in details as we go on. Okay. So discounting methods are quite popular in investment appraisal. So these are some of the methods that are there that we can use to appraise a project or to evaluate a project or an investment. So number one, we have a discounted payback. Number two, we have net present value. Number three, profitability index, PI. And the number four, we also have internal rate of return, IRR. So these are the four discounting methods that we can use to appraise a project. So discuss these in details. We'll also do some calculations so that we understand how we can use discounted payback, how we can use net present value, profitability index, PI, and internal rate of return to evaluate whether a project is viable or not. And then what are the other methods? What are the methods under non-discounting methods? So for non-discounting methods, we have two methods that we can use to appraise or to evaluate a project. So number one is the payback period. Then the other one, number two, is accounting rate of return, ARR. So these, I think we are going to look at them in two details so that we understand how we can use these methods to appraise a project. So we start with the payback period, which is a non-discounting method. So how does it work? How can we use a payback period, PBP, to appraise a project? So this is how it works. So the payback period is defined as being the number of years it takes for a project to recoup the original investment in cash terms. So basically, the payback period, we are talking about the number of years it takes for the project to recoup the original investment in cash terms. So to recoup simply means to recover the money that we have spent, the money that we have injected in the project. How long does it take for us? How long does that project take to recover that money that is spent on a particular project in terms of cash or in cash terms? So start from zero. We generate, at the end of the year, we have so much cash that we have generated. The following year, the third year, just like that, until we have recouped the investment or the original investment in money forms. So we'll also look at it. We'll look at an example so that we can be able to understand what it means, or how we can use the payback period method to determine whether the project is viable or not. The payback period is compared with a target period. If the project pays for itself sooner, then it should be accepted. If not, then it should not be accepted. So you have a target, a target period, the number of years that you want that project to recoup the original investment. For example, you will say at least in 4 years, we are supposed to start making a profit. We are supposed to recoup the original investment. So if you evaluate, or if you do the calculation and then you discover that in 2 years' time, you are able to recoup the original investment, then it means that project is viable and you go for it. If you are recouping the project, I mean the original investment beyond the target period, for example, we are saying 4 years, then your equipment is at 6 years or 5 years, then that project is not viable and you have to reject that project. The payback period is useful when the future flows or future cash flows have a high level of uncertainty. So we are saying this method of appraisal is useful when the future flows, cash flows, have a high level of uncertainty, where we are not very sure of the future, what the future holds. That's where this type of method is very useful. Okay, payback period, we are still on payback period. The further into the future we are forecasting, then the more uncertain the flows or the cash flows are likely to be. So, you know, it's very difficult to determine the future, to know what the future holds for us, or to forecast or to project the future, because we don't know the factors that will determine the cash flows in the near future. So we are saying the further into the future we are forecasting, then the more uncertain the cash flows likely to be. So no wonder this method is useful. By choosing the project with faster payback periods, we are more certain that the project will indeed end up making a surplus. Yeah, so a project which is able to recoup or which is able to pay back faster, it means that project is a good project, and definitely will be able to make a profit out of it quicker than a project which is taking long. So that's basically the idea. Okay, so we have an example. So this example says, consider the following case study. Longozani Mudenda has 200,000 available for investment. He is considering investing in a gate and tank stand fabrication project in Kalingalinga, Osaka. The estimated annual cash flows are as follows. So in year one, he anticipates to generate 40,000. Year two, 120,000. Year three, 150,000. Year four, 160,000. Year five, 180,000. And the original investment is 200,000. So you are investing this 200,000, and the anticipation or the estimated cash flow for 5 years. In the first year, 40,000 up to the last year. So last 5 years is the target. That's the target period that we are looking at. So the initial cash outflow involves the investment of 200,000 in plant and machinery for application. Okay, so this is how it works. So the question says, calculate the payback period in years and in months. So this is how you do it. This is how you Okay, so this is how you do it. Step one, we need to determine the cash flows. So this is how you determine the cash flow. So you're going to have two columns. The first column for years. So you are starting at year 0, year 1, year 2, year 3, year 4, up to 5. Then in the second column, you have cash inflows, stroke, or in brackets, outflows. So under here, we are saying in year 0, this is the year of the year when we are just planning to start the business. This is the year in which we have organized the 200,000. So when it comes to starting, we are just planning. We are planning, and in year 1, that's when we start the project. So in year 1, we are just starting, we have the capital, we embark on the project. Then in year 1, we start making these sales. So we are anticipating that in year 1, that's when we'll start selling, whether it is selling, whatever it is. Okay, so this is how it is done. So let's move on to the next slide. So now, how do we determine the period where we are going to recoup the original investment, which is 200,000? So this is how we are supposed to do it. So this is step 2. So step 2, we are saying calculate the cumulative cash flows as follows. So you calculate the cumulative cash flow. So this is how you do it. So you have two columns as well. Yeah. So for years and in the cash flow, cumulative cash flow. So you start at year 0 up to year 5. Then under year 0, where you are starting your investment, you have this 200,000, which is the original investment. Then we are told that in year 1, we are going to make 40,000. So when we make 40,000, what is going to be the cumulative cash flow? So 200,000, it begins as a negative figure. Why? Because this is the cost. So no wonder we have it in negative. So we put a negative on 200. Then in year 1, we are told that we are going to make a positive, or we are going to make a 40,000 cash inflow. So since we are accumulating, we are starting at 0, 200. So when we add 40,000 to negative 200, we are going to have a negative 160,000. Then we go to the next year, which is year 2. So in year 2, we are told that we are going to make 120,000 as the cash inflow. So we accumulate again. So we are at negative 120 plus a positive 120,000. So when we net the two, we are going to have a negative 40,000. We are still going. We have not yet recouped the investment. We are still in 0. So until we are in positive, that's when we'll say we have recouped the investment. So we move on, we go to year 3. So under year 3, according to the information, we are told that in year 3, we are going to make 150,000 cash inflow. So since we are accumulating, previously we were at negative 40,000. So we add 150,000 to negative 40,000. So when we add the two, we are going to have we enter now a positive 110,000 positive. So meaning that between year 2 and year 3, that's when we are recouping the original investment. Okay, that's when we are recouping the original investment. So you can go on. We have 4 if you want, just for completeness sake. So in year 4, we are told you are going to make 160. So since we are already positive at 110, so just we are accumulating. So we add 110 plus 160, we are going to have 270. In year 5, we are told that we are going to make 180,000. We are already at 270,000. So we just add that to that. We have 450,000 cumulative cash inflow. So now the question is, how do we know the exact year and the months? Because remember the question was saying calculate the period, payback period in years and months. So since it is in between 2 years and 3 years, we need to use a particular formula to determine the exact years and the months. Because here it's difficult to tell, to say, you can't say it is in year 5 because it has happened in between year 2 and year 5 and year 3, sorry. So now the question is, how do we determine the exact years and months or the exact period? Okay, so this is how it works. So you do step 3. So step 3 checks in which year the cumulative cash flow is negative. So which year is a cumulative cash flow negative? The last cumulative cash flow, which is negative, so it is in year 2. So this is after year 2. Therefore, payback period is 2 years plus some months, which we don't know. So 2 years plus some months, which we don't know. So the number of months are calculated as follows. So we go to the next slide where we see how we are supposed to calculate the number of months. So this is how it looks when we combine the annual cash flows stroke outflow stroke inflow and the column for cumulative cash flow. So this is what we did, and we are saying in year 2, that's where we have recouped the investment and some months. So the months they are in between 2 and 3. So how do we determine now the exact months or the exact years and months? So this is how we determine. So we use a formula. So payback period is equal to A plus negative B over C. So A is the number of years where the last negative figure was found. So this is year 2. So 2. So you put 2 here as the number of years. Then now, how do you determine the specific months since it is between 2 and 3? So you get the 40,000, which is the negative, the last negative. Then you divide the annual cash inflow in this column, which is 150,000. Okay, then you multiply it with 12 months, since we want to know the exact months that we are talking about. Okay, so this is how we do it. So 40,000 over 150. So when you multiply this, you are going to get, then you multiply by 12. When you multiply that, I'm sure you'll get something like 3. So let's try. Let me try to calculate on my calculator. So we are talking about 40,000 divided by 150,000 times 12 months. Yeah, so when you multiply that by 12 months, you find you get 3.2, or if you like, you can just say 3. So 3 months. So it means we are recouping our original investment in 2 years and 3 months period. Okay. And then the target period is 5 years. So if we are able to recoup our original investment in 2 years' time, then it means this project is viable. We are supposed to accept the project. But if the recoupment was after 5 years, the target period, then why should we even waste our resources by investing into this project, which is not going to give us our original investment soon? So this is how you can use payback period to appraise or to select a project which is viable. Okay, so we can also discuss about the strengths and weaknesses. So what are the strengths and weaknesses of payback period? So number one, strength, it is easier to use and understand. So as you have seen, it is very easy to use and understand. You can calculate it very easy, even to understand. Someone, you can explain to someone and they'll be able to understand easily. Then number two, strength or advantage is that it can be used as a measure of liquidity. Yeah, so because of we are talking about the period. So in terms of liquidity, when we talk about liquidity, it is always a desire of a business that they have liquidity anytime soon. They have liquidity every time as a business. So no wonder we are saying it's the measure of liquidity. So if our payback period is 2 years, between 2 years and 3 years, then it means the liquidity is good. We have liquidity as a business, we have cash. But if it's beyond 5 years, it means there's no cash. It is taking too long to recoup the original investment. As a result, the liquidity is not good. So you can use it as a measure of liquidity. So for projects which have got a short payback period, it simply means that our liquidity, the liquidity into that project is good. And that is good for the business. So what are the weaknesses or disadvantages or weaknesses of payback period? So number one, it does not consider cash flows beyond the payback period. So the disadvantage, as you can see, payback period does not consider cash flows beyond payback period. As you saw on the example that we are looking at, our interest is just between 2 and 3 years where we are recouping the project. But we didn't care, we didn't bother about the years beyond the payback period. Our interest was just to ensure that we are able to recoup the investment within the shortest period of time. But the other cash flows that we are able to generate beyond the payback period, it's none of our business. So that's the advantage, that's the weakness Then cutoff period is subjective. So as you can see, the cutoff period definitely subjective. Depends. Then the other thing is that it ignores the time value of money. So it ignores the time value of money. So the only interest there in payback period is to recoup the original investment. So whether after the payback period you are going to make more money, that is none of our business. As long as we are able to recoup the investment in the quickest possible time, that's what it cares about. But a true or a good project is that which has the time value of money, meaning that we are looking at the future. You are looking at how much you are going to make in the future. When you invest today, how much are you going to make in the future? When you invest 200,000, how much profit, how much cash inflow are you going to raise in the future? So for payback period, it ignores that time value of money. Then the other weakness is that it also ignores the risk. So the issue of the risk is also ignored. Okay, so we can proceed. Okay, the other non-discounting method, or the last non-discounting method that you can also use in appraising a project or evaluating a project is what we call return on investment, or ROI, or accounting rate of return. This is just the same. So ARR, accounting rate of return. So this approach is an accounts-based measure and considers the expected profitability of an investment. So this one, it is an accounting, it is based on accounts measure. The reason being that we are using the profits, accounting profits, and not cash flows. We don't use cash flows under ARR, or return of investment, but we use accounting profits. No wonder we are saying the approach is an accounts-based measure. So the formula for calculating the ROI, or accounting rate of return, is given as follows. So it's equal to average profits per annum from an investment. Then you divide the average book value of the investment. So the average book value of the original investment, you divide into the accounting profits, or average profits per annum, and then you multiply it with 100%. Then you'll be able to get a percentage, which is the rate of return, how much you are able to make from this project. So based on accounting profit and not cash flows, then the ROI, or ARR, is compared with a target rate of return to decide whether or not the investment is worthwhile. Okay, so usually you are going to have a target of return, a target rate of return that you need to compare with. So you calculate your ROI or your ARR, then you have a target which is set. So the business will set a target to say, this particular project, our target is that it is supposed to give us a return of 30% or a return of 40%. So if we evaluate, if you calculate using the accounting profits that we are expecting to generate from this project, and we discover that the rate of return is below the target, then we will not accept the project. But if it's above the target, then definitely that project is worthwhile, it's viable, then we accept the project. So the target rate of return will normally be the current return on capital employed for the company. Okay. Okay, so we have got this example. We can use this example to calculate the return on investment or the accounting rate of return. So calculate the ROI or the IRR for the following projects. So this is the project that we are looking at. It has got 2 columns, there's year and annual profit. So up to year 7, these are the profits that we are expecting to make. So in year 1, we are expecting to make a loss, which is 10,000, year 2, 30,000, year 3, 60,000, year 4, 80, year 5, 120, year 6, 50,000, year 7, 4,000. So these are the expected profits. So using the formula that we were just discussing, this is how you can calculate the accounting rate of return or the return on investment. Okay, so the initial cost of investment, we are told that the initial cost of investment is 350,000. So we are given the initial cost of investment, it's 350,000. Then the value of the investment at the end of 7. So at the end of year 7, we have a value that this investment is going to be, and it's 50,000. Okay, so here is the solution. So ROI or I or ARR is equal to average annual profits over average value of investment times 100%. Okay. So how do we calculate the annual, sorry, the average annual profits? So can we add this so that we determine the average annual profits? So we can add, let me just open a calculator for you. Okay, so we have a 10,000, which is negative. So negative 10,000 plus 30,000. Okay, we have 20,000. So 20 plus so 20,000 plus 60,000. We have 80,000. 80,000 plus 80,000. We have 160,000 plus 120,000. We have 280,000 plus 50,000. We have 330,000 plus 4,000, sorry. we have 334,000. So we want the average annual profits. So we divide this by the average number of years, which is how many years are we expecting to have this investment? 7 years. So we divide by 7 years. So when we divide 7 years into 334,000, we are going to have 47,714.29. So this is the average investment. Okay, let me show you how I've done it. So basically, I was just adding the figures according to the number of years. So in year one, we had the 10,000. Which is negative plus 30,000. We have 20. Plus 60 plus 18. So plus 16. We have 80,000. So we are calculating the average profit. So in year, so the year 2, year 3, and in year 4, we have 80,000. So we add 80,000. Then you're going to have 160. Then year 5. 5 is how much? Year 5, 120. So we have 120 in year 5. 120,000. We add the 2, we are going to have 280. So in year 6, we have 50,000. So we add the 2, we have 330. In year 7, we have 4,000. And the total is 334. Okay, so this is the total. So this is our total profits. Now we want to determine the average. So the average will be, just divide this by 7 years. So 334 0 divide by 7 years. So when we divide this, definitely we are going to have 47,714.28 if we round off 0.29. Just confirm. Yes. So this is how you come up with the average profit. Then what about the average value of investment? So for the average value of investment, got two figures: the scrap value, or the value at the end, and the initial investment. So we add the two. So we have 350,000 plus 50,000. Then we divide by 2. So for investment, the average is to find the average, you add the 2, then you divide by 2. So when we divide by 2, we are going to have, we add 350 plus 50,000 divided by 2, we have 200,000. Then we can divide 200 into 47,714.28 multiply by 100%. So our return on investment, or accounting rate of return, is at 24%. So the question is this project viable? So we need now to compare the ROI, or the ARR, which we have calculated, with a target rate. So the project will have a target rate, then you compare. So if the 24 is more than the target, then the project is viable. And if not, if it is less than, then the project is not viable. So the project viable if 24% was higher than the target rate, or else not viable. So this is how we can use return on investment, or accounting rate of return, to determine whether the project, to evaluate whether the project is viable or not. I hope this is making sense. Okay, so what are the, unless they are, okay, so what are the strengths and the weaknesses of ARR? So these are the strengths and the weaknesses. So number one strength is that ARR is very simple to calculate. As you have seen, it is very straightforward and simple. Number two, it is also widely used. Number three, it is also easy to understand, just like payback period. It is also easy to understand and simple. And what are the advantages? Or I mean, what are the disadvantages? What are the weaknesses? So the weaknesses are basically that one, which ignores the time value of money, which I already explained, which is also similar with payback period. Then also the issue of the risk. So the risk is also ignored. You know, in business, you cannot run away from the risk. we've got business risks, we've got financial risks. So these risks, like business risks which are inherent, risk where a business, by nature of the business, those risks, they are just there, you cannot run away from those risks. So payback, I mean, accounting rate of return for payback period, these two, they ignore the risk, which is not a good thing. The business, as a business, we are supposed to understand these risks. We are supposed to understand these risks so that we are able to mitigate the risks as a business. We are able to reduce the risks as a business. But if we ignore, then we are not doing ourselves any good. Okay, so we are done with the non-discounting methods. So now we can now start looking at the discounting methods. So the first method we are going to look at is the net present value, or NPV, net present value. So the NPV method is based on the discounting future cash flows to present value using discounting formula. So use NPV method is based on the discounting future cash flows to present value using the discounting value. So you discount the future cash flows. We discount the future cash flows. We bring them to the present value using a discounting factor or a discounting formula. So net present value, it is as simple as that. We have to discount the future cash. So the future cash flows that we have estimated, we simply discount them to the present value. So basically the future cash flows will have more higher values. So we bring them back, or we reduce them, we discount them so that we know or we understand that the present, as that today, how much will these future cash flows be today. So basically that is the idea about its present value. So discounting is based on the concept of time value of money, which states that a kwacha today is more than a kwacha tomorrow, because today's kwacha can be invested to earn interest. So this is basically what we mean when we are talking about time value of money. So the time value of money says that, or states that a kwacha today is more than a kwacha tomorrow, because today's kwacha can be invested to earn interest. So when you invest a kwacha today, after 1 year, the money that you are going to make from one kwacha will not be the same money that you have today. So when you invest, you expect to gain in that investment to gain your interest. So meaning that that investment is going to grow. It won't be the same amount. So no wonder, if we want to make a decision, an investment decision today, whether to accept a particular project, we are supposed to discount those future cash flows to the present values so that we know those values today, or those future cash flows today, whether they will be valuable, whether they will be viable, whether they will be profitable. They may seem profitable tomorrow, but what about today? So we need to know their present value by discounting the future cash flows. That's what it means. So we understand it in details as we look at an example question that we will be looking at. So what are the essential tools of investment appraisal? So financial managers use many different tools to make decisions. The key fundamental tools include, so number one, the fundamental tools. Number one is the time value of money. Okay. Which I've already explained. The investment, the money that you invest today, the value of the money today will not be the same tomorrow. If you invest today, tomorrow you are going to gain interest. Or after some time, you will gain interest. Then the general cost of capital. So in order to appraise these projects using NPV, we are supposed to have a general cost of capital. We're supposed to calculate the cost of capital, and then we use that cost of capital to discount the future cash flows. Okay, so time value of money, one of the most important tools of finance, is routinely used in financial analysis and decision making. Okay, the present value or PV and future value FV are the cornerstone of time value of money. So these two, if you want to know the time value of money, you are supposed to understand the present value. You're supposed to determine the present value and the future value. Or from the future value, you're supposed to determine the present value. So from the estimated future values, we can use that future value estimates to determine the present value by discounting, using a discounting formula or a discounting factor, or using the cost of capital. Then we'll be able to know the present value of those future cash flows. When interest rates are positive, the sum of money invested today will be worthy more in future. So when we invest at an interest rate, at a particular interest rate, which is positive, definitely the money that we have invested today will be more in the future. By extension, the value of a future sum of money will be lower today than in the future. The value of the future sum of the money will be lower today than the future. So the present value today should be lower than the future value. That's the meaning there. Determining a present value or PV, which is today's value, or the future value FV, which is the value at some future point, requires the three inputs. So if we want to determine the present value or the future value, we are supposed to have these three inputs. Number one, the cash flow, CF, that is it to be paid or received today or in the future. Number two, the relevant time horizon. So time horizon, the time, for how long? Is it 5 years? Is it 3 years? Is it 4 years? Is it 10 years? It's very important. We are supposed to know the period that we are looking at, the period that we are intending to invest in a particular investment, in a particular project. Then number three, the proper interest rate, discount rate, or cost of capital. The terms are interchangeable. So we can either have interest rate discount rate, or cost of capital. They are just one and the same. You can either have any of these. So these are the three important inputs that we need to determine, if we are to determine the present value or the future value of an investment. We're supposed to know the cash flows that will be received, that will be paid in the future, today or in the future. Then we also need to have the time horizon, to know the time frame. How many years are we looking at for this investment? Embark on this investment. Then the last one, the interest rate or the discount rate or the cost of capital. Very, very important. Let's begin with PV, or the present value. If we are to receive some cash in future, we know that it will be worth less today than tomorrow. So if we are intending to receive some cash flow or some cash in the future, what it is worthy today, it is usually less than what we are expecting to receive in the future. That's what it means. This means we must divide or discount the future cash flow by the discount rate over the time horizon in question. This simple relationship can be captured by the following. Okay? So to find or to determine the present value of the cash, the future cash flows, the future value, this is how we are supposed we divide the discount rate into that cash flow, that future value. So this is the formula that we can use. So we say cash flow or future value divided by 1 plus discount rate raised to time horizon. Okay. So the denominator can also mean discount factor. So if we are already have the discount factor, we just divide that discount factor into that. If we don't have the discount factor, then we use that formula 1 plus discount rate to the power time horizon, to the power n, number of years. This formula is straightforward and powerful. It reduces the value of cash flow that we expect to receive in the future by discounting rates. Meaning we can make decisions today using the today's discounted cash flows. So the idea is that why we want to discount, we want to have to know the present value of those future cash flows. When we know the present value of those future cash flows, then we can make a decision whether to invest into that business or into that project or not. Because you cannot base your decision on the future cash flows, because we don't know how much those future cash flows are worthy today. So no wonder we need to discount those future cash flows so that we come up with the present value. Then from there, that's when we can make a decision, an investing decision. The reverse of the PV calculation is, of course, the future value calculation, or how much a series of cash flows will be worthy in the future. If we invest a cash flow today we know that it will be more worthy more in the future. This means that we must now multiply or compound the current cash flow by some appropriate rate over the relevant time horizon, and can do so via. So this is the formula that you can also use to determine the future given future value given the present value. So instead of dividing now, we are going to multiply. So we multiply cash flow, the present, times 1 plus discount rate to the power time horizon, or n. Okay, so this is how we can calculate the future value given the present value. Cost of capital used in discounting methods. Okay, so the cost of capital used as the discount rate in the computation of future value and the present value. So we use the cost of capital to calculate or to compute future values and the present values. Then the discount rate captures the cost of capital and the return required from the cost of the investment based on its risk profile. So the discount rate has got the risk embedded in it or included in it. So the cost of capital, we add the interest rate. So meaning that we have taken care of the risk, which is ignored usually by those other methods like the payback period and the accounting rate of return. They don't include the risk, but here we are saying we include the risk. So we have got two costs that are included in the discount rate. One, the cost of capital. Cost of capital coming from the business risk, and the interest rate also coming from the financial risk. So we put these two, then we have discount rate. So the point is fine to explain. So the cost of capital consideration. How do we come up with the cost of capital? So the capital for an entity can be divided in two forms. One, equity. Two, debt. So this is how we determine the capital for the entity. Remember, equity plus debt. Then we have total capital. Each of these components have a different cost attached to it. So we have a cost of equity, then we also have the cost of debt. We add the two, then we have the cost of capital. The weighting of the two capital sources and their respective costs determine a company cost of capital. That in turn influences its valuation. So we can also weight the two capital sources. So when we weight the two capital sources, this is what is going to happen. This is what we're going to have. So the company cost of capital is going to be weighted average cost of capital. And this is also known as WACC, weighted average cost of capital. So we can weight the two capital sources. So when we weight the two capital sources, it means we have WACC, or we have the weighted average cost of capital. Then we will use this cost of capital at a discount rate to discount the future cash flows. Okay. So WACC calculation. So how do we calculate the WACC? Given the information. So we have got this example. So Tactus PTC Limited, PTY Limited. Okay, capital structure and cost of each. So this is the capital structure of the company Tactus. So what is the equity? The cost of equity is 25%. Then preference share capital, we have also 16%. Debt, cost of debt or interest rate, we have 12%. So we have these costs. So how are we going to discount the future cash flows given this? So we are supposed to come up with WACC. We are supposed to come up with weighted average cost of capital, which we can now use because it has incorporated all the costs, including the risks and time value for money. Okay, so step one, how do you calculate? Step one, calculate the weight of each capital. So this is how you calculate the weight of each capital. So we are told that the equity of Tactus Limited is $600,000. In the preference shares is $100,000. The debt 30,000. Total 1 million US dollars. So now we need to weight. So this is how we weight. Come up with the weighted average. So for equity, we say 6 divided by 1,000. And when we divide this by that, we are going to have 0.6. For preference shares, we have 100,000. We divide by 1 million, and we are going to have 0.1. For debt, 300,000 divided by 1 million, we are going to have 0.3. So we have weighted the three source of capital that we have as a business. And when we add the three, it's supposed to give you 1. Then step number 2, we calculate weight. How do you calculate the weighted average? Very simple and straightforward. So you have the source of capital column, then we have the cost, we have the weight that we have just calculated, then the last one we have the contribution, how much it is contributing. Okay, so this is how you do it. So for equity, we are told that the cost is 25%. So we are waiting now. We want to have a weighted average cost. So we multiply 25% times 0.6. So you'll be able to have 15%. Okay, then preference shares 16% times 0.1 or 1.6%. For the debt, you have 12% times 0.3. You have 3.60. We add the 3. What is the weighted average cost? We have 20.2%. So this is the weighted average cost. So this is how we can calculate the weighted average cost of capital. So we use this now as a discount factor. Why? Because it has also incorporated the risk. Okay. Unlike just the cost of capital, which has no any other risk. So we wait so that we have the weighted cost of capital. Okay, so we can end here in this session. Then in the next session, we are going to continue looking at how we can appraise a project using NPV. So look at the examples of how we can use NPV to appraise a project. This topic is very important, the net present value, and be rest assured that you are definitely going to have a question on net PV, how to calculate the net PV, how to appraise a project using net PV. So I'll see you in the next session, next video. We are going to look at how we can use NPV to appraise a project or to evaluate a project.